Hi there, it's Chad here with Living the Dream Real Estate Group. And today we are spending another time with our mortgage panel so we can talk everything to do with mortgages. So we just had another rate decrease by the Bank of Canada. So we're going to have a little deliberation about what we thought about the rate announcement that was just delivered by Tiff Macklin. We're also going to jump into a couple of things to do with first-time buyers. We're starting to see some first-time buyers start to creep into the market. And as that happens, there are some things that those first-time buyers need to be aware of. So we're going to jump into that. We're going to look at some other general information, just what we're seeing as trends and some products that were coming onto the market, and then get into our predictions for what we're going to see over the next year, or at least what we think is going to happen in the next 6 and 12 months with our crystal ball predictions. So stick with us as we jump into everything to do with mortgages. Let's jump into the pod. Chad here with Living the Dream Real Estate Group. And today on our podcast, we have our mortgage team back. We have June Ellen, Jordan Jans, and Jeff Shinkuski joining us, mortgage brokers that are here based in the Okanagan that are providing services to all those folks that are looking to either refinance or to get mortgages for their purchases. So team, we just had an announcement that just came out from the Bank of Canada, and we are just going to talk a little bit about some of our thoughts on that. And we're going to just have a gander at, and we're going to listen to one of the things that Tiff Macklin had to say in recent weeks here. So let's pull up Mr. Tiff Macklin, see what he had to say.
Today, we lowered our policy rate by a further 25 basis points to 4.5%. This decision reflects three considerations. First, monetary policy is working to ease broad price pressures. Second, with the economy in excess supply and slack in the labor market, the economy has more room to grow without creating inflationary pressures. And third, as inflation gets closer to the 2% target, the risk that inflation comes in higher than expected has to be increasingly balanced against the risk that the economy and inflation could be weaker than expected.
Drawback, I've got family in town and everybody's using the Wi-Fi. So there you go. But what we'll do is we'll put that back in after the fact. But some comments. So I would love to hear from each of you. When it comes to the Bank of Canada's announcement this last week here, what were your predictions and what do you think of the results? So how about Jeff? What did you think of the announcement? What was your prediction?
Yeah, my prediction was a quarter point decrease. I was kind of testing the waters to see if maybe a half point to be a little bit cheeky, but didn't get that. I predicted a quarter point. I think the inflation's going in the right direction. At least it's holding at a high 2% rather than jumping back into the 3%. And I hope that Canadians can see that the government's finally listening, the Bank of Canada is listening. And to try and curb some spending here, just keep that inflation rate going down.
Mm-hmm. How about you, June? What was your prediction and some of your thoughts?
Oh, excuse me. So my prediction also was a quarter point drop. And it's interesting to see how many people are really watching and listening for these announcements and the rush of calls you get before and after to see how that assists them and where it changes their mortgage eligibility. So
oh yeah, it's like burning up the phone lines for sure.
Yeah, just clear that day.
Yes, absolutely. Jordan, how about yourself?
Well, I was pretty pessimistic going into it. Up until a week before the date, a lot more articles from economists were coming out, being a lot more positive. And then at that point, kind of reading more into it, I was pretty confident we're going to see that quarter point decrease. I thought Jeff was pretty optimistic with thinking it might be a half point, but you can't. It doesn't hurt to be optimistic. But it makes sense that we hit that quarter point decrease, and I think we'll just have to kind of see what comes down the line here.
Mm-hmm. I too, there was a part of me that was thinking it was going to be a hold, but when, getting back into just prior to the announcement, spent some more time reading. And yeah, it was just really with the signs that were going on is that I was thinking that was going to be a quarter rate drop as well. And so thankfully that has been the case. So all around, I think that's developing some confidence in our marketplace, and that's one of the things that we don't see enough statistical information on is the confidence of the marketplace. And once we see that confidence increase, we'll see some more people dropping into the market. But as we look back to these rate announcements, Jordan, one of the things that you and I had talked about a little bit in the last little bit here is we've seen a lot of changes in the types of products that we're seeing from the lenders out there. What's your take on some of the changes that we've been seeing?
So yeah, like compared to earlier in the year when rates were still pretty high, but the writing was on the wall that we're going to be seeing those decreases coming. Nobody really knew how fast or how aggressive we would see that kind of decline in rates, but everyone kind of realized, okay, rates are going to be high right now, so we're looking for lower terms. So I was doing 2 3 year terms almost exclusively, where
Mm-hmm.
now people are coming with lenders out there are being a lot more aggressive on 5 year terms. They know we're kind of hitting closer to that plateau that, hey, this could be very advantageous. So they're throwing out some very aggressive, nice low rates that are definitely attracting people. So I get a lot more conversations with people about, should I get a 5 year term? Does this make sense? For some, it might, if budgeting affordability. But in general, it's still a lot of 3 year terms. Done a couple fives, but there's also some lenders out there that offer 3 year variable products, which are very attractive right now for certain people in certain situations. Some of these aren't the best rates, but given the downward decline in those prime rates, it might be a very good option for somebody who needed some flexibility in the next 3 years with their mortgage.
Yeah. And as we are starting to see these rate changes, we've been waiting for and seeing some of these first time buyers start to trickle into the marketplace. We're starting to see the prevalency of that, and it's encouraging. That's really what we want to see. But June, one of the things that we've talked about previously is just some of the misconceptions that, for especially first time buyers, some of the misconceptions that we're seeing for some of those programs. Do you want to speak to some of that?
Sure. Actually, the one, and I saw this very recently, is the first home savers account. There are some misunderstandings about it. Some people think that it needs to be held in an account for 90 days, like a TFSA, which it does not. It can be put in and taken out the very same day. I bought a home recently and I used that. And when I went to the bank, they told me I could not do that. I could not use the home savers account that way. So it was very interesting to be on the other side. It was very educational, actually, to be, at the bank. And my daughter was there and she said, well, I would have just came home and said, oh, no, we can't do it. So I worked with the rep at the bank to show him that we could, in fact, do that. So I think, there's some misunderstandings about how that is used. And same with the RRSP program, the home buyer plan. You can use it more than once. And not everyone understands that, right? There's a time frame in between owning a home and using that program and then reusing that program. But you can use it more than once. And a lot of people need to use their RSPs towards their down payment and pay it back.
Yeah. And it just goes back to having to be super creative. And that's why this team is so good at that, because they're looking outside of the box for the opportunities that exist and can exist when people, like you say, are thinking like all is lost and that we're not going to be able to make something happen. But they can at least go back and, especially by working with one of you as professionals, they can come back and find that, yes, there is some opportunities there. So, as we think about that now, Jeff, about 30-year amortizations for first-time buyers, could you speak to some of that, how it could benefit the borrowers going to a 30-year?
Yeah, absolutely. Excuse me. I think this is a good sign that just showing that the government's listening. The government does see that we have a shortage of units. Now we have more rental units coming up, especially here in the Okanagan. And then the affordability factor. When you extend an amortization from, say, 25 to 30 years, yes, you are adding a bit more interest, but your actual monthly payment does come down. So from an affordability standpoint, that could definitely benefit the borrower. Less than 20% down payment. It's got to be under $1 million. and you can now do a 30-year amortization just on new construction, new builds. One thing
Mm-hmm.
to note is that you're going to have an insurance premium, and a stuck point that a couple of my clients are running into is they're super excited to be able to put down 5%, but a lot of the builders or developers are now looking for a 10% minimum deposit.
Mm.
So with certain developers, the 5% might not be an option, but they could discuss with their builder or developer if they could maybe get an exception. But at this time, less than 20% down, there will be an insurance premium. I've got to be under $1 million and a brand new build. You can have a 30-year amort.
Hmm. Really good. Okay. Hey, Jordan, I'm going to put you on the spot for one other thing that we saw, especially when it comes to first-time buyers, is that here in British Columbia, our government recently had said that they were going to, for rental units or tentative properties, they were going to use and have a 4-month notice needed to be given if you were purchasing a property that you would be able to move in. You'd have to give that tenant 4 months notice if you wanted to move into that property. Well, of course, through a lot of lobbying from some associations and from hearing people like me and from people like you guys to say, no, that needs to change because we can't rate hold for that long. We saw that change go from 4 down to 3. Any comments you want to have for that?
Yeah, I mean, so first off, yeah, as we chatted previously, I was like, that 4 month hold is going to kind of ruin the whole market of people going in there because lenders typically are only holding the rates for 120 days, which means the timelines just really wouldn't add up, which I guess the government didn't really realize. That's how, real estate financing kind of typically works. So once, like you said, a lot of the associations, like the mortgage brokers, realtors, everyone spoke up, they listened. They did adjust that back down to 3 months, which is fantastic. But now they also have the period where you can basically battle that go to 21 days, which is typically longer than subject to financings on purchase, which might also cause some issues potentially down the line. So that's also something we're going to be looking out for here in the future. But in general, it's good to know they're listening. 3 months is going to be very tight timelines still.
Mm-hmm. Yep.
And it's going to cause obviously just a slow purchase for anybody looking to buy a tenanted property, which it is what it is. There's issues renting in the Okanagan for sure. So you got to look at both sides of the coin there when you're making these decisions. And I don't know if there's any easy decisions to be made, but at least we got it down from that 4 month. So that's a good sign.
Oh goodness, when they came up with a 4 month, it was just like,
yeah,
are you serious? Okay. And you know what? That's unfortunate sometimes when some of these the messaging or at least the policies are made in absence of a lot of I'm hearing from the people that are on the streets or the industry that is actually doing the work of this. And yeah, like you say, thankfully they came back and listened to mortgage brokers associations as well as the realtors and got that changed because that's helpful. But even 3 months, it's going to be a little bit challenging. But let's get back to mortgages. In June, one of the things that you had brought up when we were talking earlier about how do you get a mortgage when you have liquidable assets but limited income. You want to speak to that?
Sure. So some of the lenders have what's called a high net worth program. And so perhaps, and we see this a lot in retirees. So they have their old age pension and their CPP, maybe a work pension. That's their only income, and it's not enough to qualify for the mortgage that they're looking for. But they have a ton of RRSPs or investments. So any amount over, most lenders, 250,000, any amount over that that they are holding, we can use dollar for dollar in qualifying for a mortgage. So they've got 500,000 in investments. We can use that 500,000 towards the qualifying of the mortgage along with their income. If they're registered investments, we have to take off 30% for tax. But it's very helpful for a lot of people who just don't have that income coming in, but they have access to the money. They could pay for it. They're just making more interest keeping their money in investments than they would pay for the mortgage.
And you know why that is so interesting is that we here in the Okanagan, maybe it's different from some of the jurisdictions that you're hearing or watching us from, but one of the things in the Okanagan is that we're seeing our average age starting to continually increasing. So we're seeing more and more folks that are in this situation where they're retired and they're in that position where it's like, okay, this this is going to be that's great to know for some of them. Um, Now, when it comes to some purchases, in fact, I have a gentleman that was just reached out this last week, and he was saying, "Well, you know what? I really love to get that house. I'm in a situation right now that may be a little bit tight for me." They asked, "Is that mortgage assumable?" So, Jeff, I put it to you.
Mhm.
What's an assumable mortgage? And that could be a very long answer, but if you could keep that brief, what's an assumable mortgage, and how can sellers use this to their advantage?
Yeah, so just speaking from the BMO product, it might change per lender, but it's basically like porting your current mortgage to the new buyer with the same rate for the same amount of money. So with BMO, we're able to now sell or assume mortgages when a seller comes in from whoever is holding the current mortgage. If there is additional funds put on top, then we will blend that rate with the today's rate versus what the other rate was. That's
Mm-hmm.
assumable. But if it's very close and someone has maybe a 3 year fixed at, back in the day, maybe at 3%, it's a good selling feature, right? Because someone may not be able to get that low of a rate. Sometimes, if you have a nice low rate, then your qualifying rate is a lot lower as well. So potentially this person could qualify for something that they couldn't qualify with before. So definitely, if anyone does have a place for sale, talk to their lender to make sure that A, it is assumable, and then to have realtors and brokers and sellers just have more conversation about it and be able to answer any kind of questions as well.
From that perspective, that's one more conversation that I can have with potential sellers. That could be a game changer, because as we're starting to see our listings gradually increase, even as we come into the latter part of I guess halfway through the summer, it's
Mm-hmm.
going to be interesting to see how that can change. Good,
Mm-hmm.
thank you.
Yep.
So we are starting to see some changes. We're seeing some positivity from the Bank of Canada that we're having these rate decreases. When we're seeing like what our prime rate is right now at 6.7, we're seeing our inflation 2.7. What do you, Jordan? How about this? How much do you think that the prime rate is going to need to change in order to see some public perception start to change? Like, what are we going to need to get to for some other real holistic changes to happen?
Well, that's a great question, and I mean, my answer is I feel like it's going off mostly gut feeling, which is public perception. Like I do keep track of a lot of media and kind of what they are saying and how that does kind of, what that does to the public's perception exactly of the market and what things are happening. I think we're gonna have to see it cut anywhere from half to a full point, probably like 0.75. I think we gotta get the discounted rates of variables into those 5% interest rates. So the prime rate needs to be sitting, points like zero point 0.5 to 0.75 lower at least, and then we'll be seeing those kind of low fives. I think when we get to that point is when we're going to see some. I won't say it's normalcy return, since it's been kind of wacky few years, but I think we're going to see a lot of it stabilize at that point. I think media also at that point will get the green light to say things are looking good, and then that will just trigger everybody thinking, okay, everything must be fine now, because everybody does follow very much what the headlines on media says without
Mm-hmm.
actually understanding or acknowledging the context or like what is actually happening behind the scenes. So I think until we actually see some meaningful cuts and media starts actually like saying like, hey, we're basically kind of hitting where we should be now, we're right on track, I think people are going to be holding out a bit until that point still.
Mm-hmm. Mm-hmm. As we talked just before going live here, just with regards to what's happening down in the States with the Fed Reserve looking at what they're needing to change, and there was a little bit of market instability in the last little bit, just because they're trying to find the same soft or a similar landing to what Canada's been able to do, and some over there down south are thinking that maybe they left it a little too high too long. We are going to be starting to see some real crucial times here as we come up into September, which is our next rate announcement coming up in September the 4th. So I'm going to ask you two questions, panel. First of all, it's what are you thinking is going to happen in our next rate announcement? And I know that can be very open-ended, but let's keep that brief. And then also what you think for the next 12 months. If we're going to look at a wild crystal ball and just kind of see, well, where do we kind of foresee and what are we seeing for rate changes? What are your thoughts? Jeff, how about yourself? Why don't you start us off?
Yes, thank you. I think another half a point between now and the end of the year. So I think September 4th announcement will be a quarter point low. I think we'll gain some consumer confidence if the Bank of Canada is able to say, hey, congrats on the inflation. And within this one calendar year, we've brought it down by 1 full point. I think if that is to happen, I think they're going to give it probably 4 or 5 months of not touching it in the new year once the presidency might change or whatever happens down there. It's a cautious time when it comes to setting interest rates with an election year, handing over the keys beginning of next year in the White House. So I think that they're going to do a full point by the end of this year. We're already at half a
Mm-hmm.
point, and then they're probably not going to touch it for another 6 months just to see where's inflation land and what's going on with our friends down south.
Mm-hmm.
Mhm.
Right on. Yeah, and there, as we talked about too, is that there's a big election that's coming up, so that's going to have a lot of impact on things as well. Jordan, how about yourself?
So I kind of agree and disagree with what Jeff was saying there. So I think we're going to see that same kind of half point reduction. I'm not sure we're going to see it all this calendar year or if they're going to hold out and have one drop early next year. I'm thinking like this next September, we're going to see a hold. And I think they're going to just wait out a little bit. I think with inflation, yeah, I mean, Tiff had some great optimism and stuff there. But as soon as the general public hears about that, spending will go up. That'll kind of curb that, I believe, especially as we near into the holiday season. I mean, people are gonna get the green light to start spending a little early. People might start spending on the holidays, Christmas presents, things like that earlier. So I think we might see an upkick. I don't think we're gonna see an aggressive cut. But like Jeff said, a lot of it depends to see what our neighbors to the south do. If they do get aggressive, we typically follow suit. And if they do decide to
Mm-hmm.
kind of something else happen and they're going to hold, then we will likely follow suit with that too. But I'm optimistic. We'll see a half point in the next, let's call it 6 to 9 months, and I think in a full 12 months we'll see about a 0.75, not quite a full point lower than we're at now.
Okay.
Yeah.
June, how about you?
Excuse me. Yeah, I agree. I think another quarter point before the end of the year. I think another one early in the year. I think we're just going to see a slow decline over the next year. It's definitely going to drop, but it's not going to be really fast. They'll take their time and stay focused that way.
Mm-hmm. Me personally, I do think that it's going to be another quarter in September, but after that, I really do think that it's going to be some holding. I think that Canada is really going to have to wait and see what happens with some more of coming into the fall, what they're going to see for projections, what's going to happen is the outcome of the election, because there's two very different standpoints on how that's going to go, for sure. Now, with regards to the next year, I think we'll probably be within that 1 full point drop on things. I think that's going to show a lot of encouragement. That's really still, when we think about it, that's more in a normalized, kind of mortgage perspective for rates. I think that that's going to be a healthy for us to get, to that point with another point drop. But it's going to be interesting. It's going to be a fun packed little bit of the rest of summer and some early fall. So we'll see how that all transpires. But team, I just wanted to thank you again for taking some time out of your busy schedules to talk to us with everything to do with mortgages. So for those that are listening or watching, this is an amazing team of folks, of some mortgage brokers that are out working on things on a daily basis. And if you have some questions, please do reach out to them, because they are an excellent resource to get all of your questions answered. So for all of you out there living your dreams here in the Okanagan, we'll check back with you next time. That's the pod.